The stock market can seem like a golden ticket to riches. For many, it represents the ultimate dream of financial freedom and independence. The idea of making money while you sleep, of seeing your investments grow exponentially, is incredibly appealing. It's a world where fortunes can be made and the barriers to entry seem lower than ever before. It holds the promise of turning modest sums into small fortunes. The stories of individuals who have struck it rich in the market are numerous and often sensationalized. These tales of success can be incredibly motivating, pushing new investors to dive in headfirst, hoping to replicate such outcomes. With the rise of online trading platforms, accessing this market has never been easier. These platforms have democratized trading, allowing anyone with an internet connection to participate. They offer a plethora of tools and resources, making it seem like anyone can become a successful trader with just a few clicks. New investors are often enticed by stories of overnight success. The media is filled with headlines about stocks that have skyrocketed, turning ordinary people into millionaires almost overnight. This creates a sense of urgency and excitement, making it hard to resist the temptation to jump in. The allure of quick profits can be intoxicating. The thrill of seeing your investments grow rapidly can be exhilarating, and the fear of missing out can drive people to make hasty decisions. It's easy to get caught up in the hype and lose sight of the bigger picture. However, the stock market is not a get-rich-quick scheme. For every success story, there are countless tales of losses and disappointments. The market is unpredictable and can be unforgiving. It's important to remember that investing always comes with risks, and it's crucial to be prepared for the ups and downs. It's a complex ecosystem with its own set of rules and risks. Understanding these rules and navigating the market requires knowledge, experience, and a well-thought-out strategy. It's not just about picking the right stocks. It's about managing your portfolio, understanding market trends, and making informed decisions. While it's easy to be swept up in the excitement, it's crucial to approach it with caution and a healthy dose of realism. Educate yourself, seek advice from experienced investors, and always be mindful of the risks involved. The stock market can be a powerful tool for building wealth, but it's essential to approach it with a clear mind and a well-defined plan. Many new investors fall prey to the illusion of easy money in the stock market. They see headlines about soaring stock prices and believe that replicating such success is simple. This often leads to frequent trading, driven by emotion rather than careful analysis. Such an approach can be detrimental to long-term financial health. The stock market is not a casino where luck dictates the outcome. It's a marketplace where companies compete for investor capital. Understanding the fundamentals of business, including revenue, earnings, and market share, is essential for making informed investment decisions. Looking back at the stock market's history reveals a striking pattern. The companies that dominate the market are constantly changing. 30 years ago, names like General Electric, ExxonMobil, and Coca-Cola reigned supreme. These were considered blue-chip companies, symbols of stability and growth. However, none of these companies remain at the top today. The world has changed, and with it, the companies that drive the global economy. This highlights the dynamic nature of the stock market and the importance of adapting to new realities. The rise and fall of Japanese companies in the global market serve as a stark reminder of the stock market's unpredictable nature. In the 1980s, Japanese companies were seen as unstoppable forces. They dominated industries like electronics and automobiles, and their stock prices soared to unprecedented heights. However, this dominance proved to be short-lived. Economic stagnation, increased competition, and a failure to adapt to changing market dynamics led to a sharp decline in the fortunes of many Japanese giants. This serves as a cautionary tale about the dangers of assuming continued dominance based on past performance. Section 5. The unpredictable landscape of American industry. The American stock market has also witnessed its fair share of dramatic shifts in industry leadership. The auto industry, once a symbol of American industrial might, has undergone a dramatic transformation. Companies like General Motors and Ford, once titans of the industry, have faced significant challenges in recent decades. The rise of globalization, increased competition from foreign automakers, and the shift towards fuel-efficient and electric vehicles have forced American automakers to adapt or risk becoming obsolete. This highlights the importance of understanding industry trends and anticipating future disruptions. Section 6. The perils of timing the market. Many investors, especially newcomers, are lured by the idea of timing the market, buying low and selling high. The concept seems simple and enticing. Buy stocks when prices are low and sell them when prices are high, reaping substantial profits in the process. This strategy, often portrayed in media and success stories, can make it seem like a straightforward path to wealth. They believe that they can predict market swings and capitalize on short-term fluctuations. The allure of making quick gains can be strong, especially when markets are volatile and news headlines are filled with stories of dramatic price movements. This belief is often reinforced by the occasional success story of someone who managed to time the market perfectly. However, history has shown that consistently timing the market is extremely difficult, even for experienced professionals. The stock market is influenced by a complex web of factors, including economic indicators, geopolitical events, and investor sentiment, all of which can change rapidly and unpredictably. Even seasoned investors with years of experience and access to sophisticated tools and data often struggle to accurately predict market movements. Market movements are influenced by a multitude of factors, many of which are impossible to predict with accuracy. Economic reports, political events, natural disasters, and even rumors can cause sudden and unexpected changes in stock prices. This unpredictability makes it incredibly challenging to consistently buy at the lowest point and sell at the highest. Attempting to time the market often leads to buying high out of fear of missing out and selling low out of panic. This behavior is driven by emotions rather than rational analysis, and it can result in significant financial losses. When markets are rising, the fear of missing out can push investors to buy at inflated prices. Conversely, when markets are falling, panic can lead to selling at a loss. This emotional roller coaster can be detrimental to long-term returns. Instead of trying to time the market, many financial experts recommend a more disciplined approach, such as dollar-cost averaging or investing in a diversified portfolio. These strategies can help mitigate the risks associated with market volatility and provide more stable returns over time. By focusing on long-term goals and maintaining a consistent investment strategy, investors can avoid the pitfalls of market timing and build wealth more effectively. Section 7. The power of diversification. One of the most effective ways to mitigate risk in the stock market is through diversification. This involves spreading your investments across a variety of asset classes, industries, and geographies. By not putting all your eggs in one basket, you reduce the impact of a single stock or sector performing poorly. Diversification helps to smooth out returns over time and reduces the volatility of your portfolio. It's a strategy that has stood the test of time and is recommended by most financial advisors. Section 8. Index funds, your steady path to growth. For most investors, particularly those new to the market, index funds offer a simple and effective way to participate in the stock market's growth potential. These funds are designed to mirror the performance of a specific index, providing a diversified portfolio with minimal effort. By investing in an index fund, you essentially own a small piece of every company within that index, spreading your risk across a wide range of assets. Index funds are passively managed funds that track a specific market index, such as the S&P 500, or the Dow Jones Industrial Average. This passive management means that the fund's portfolio is not frequently adjusted, which helps keep costs low. The goal is to replicate the performance of the index as closely as possible, rather than trying to outperform it. Index funds offer several advantages. One of the most significant benefits is their cost-effectiveness. Because they are not actively managed, the fees associated with index funds are typically much lower than those of actively managed funds. This can result in substantial savings over time, allowing more of your money to stay invested and grow. They are low-cost, transparent, and provide broad market exposure. Transparency is another key advantage, as index funds clearly disclose their holdings, making it easy for investors to understand exactly what they own. This level of clarity can help investors make more informed decisions and feel more confident in their investment choices. They eliminate the need to pick individual stocks and remove the emotional element from investing. By investing in an index fund, you avoid the stress and potential pitfalls of trying to time the market or select the best-performing stocks. This hands-off approach can lead to a more stable and less stressful investment experience. Over the long term, index funds have consistently outperformed actively managed funds. Historical data shows that the majority of actively managed funds fail to beat their benchmark indexes over extended periods. By choosing index funds, investors can benefit from the overall growth of the market, enjoying steady returns with less effort and lower costs. Section 9. A prudent approach to investing. Investing in the stock market can be a rewarding experience, but it's essential to approach it with a long-term perspective and a healthy dose of caution. Avoid the temptation of quick profits and the allure of timing the market. Instead, focus on building a diversified portfolio that aligns with your financial goals and risk tolerance. Remember, investing is a marathon, not a sprint. By embracing a disciplined approach, diversifying your investments, and taking advantage of the power of compounding, you can increase your chances of achieving your financial aspirations over time.